Good morning. It's Tuesday, the 15th of October, and this is Govindraj Ethiraj, headquartered and broadcasting and streaming from Mumbai, India's financial capital. The take. When Hyundai launched its first small car, the Santro, 26 years ago, people stopped on the road and had a hearty laugh at the tall boy design of the car. It used to look unusual. Actually, you could even call it bizarre for those times. There's nothing unusual or joke-worthy about Hyundai's mega initial public offer that opens today, but the size and timing could be a little worrisome. Hyundai is launching a roughly 28,000 crore initial public offer on October 15th. That's today, the largest ever in India's IPO history. The price band is 1,865 to 1,960 per share and will in total cross the Life Insurance Corporation's initial share sale of 21,000 crore, being the last biggest one. Hyundai's IPO is a first for other reasons as well. It's the first car company to go IPO after Maruti Suzuki in 2003, so that's more than 20 years. Second, it's a multinational listing in the domestic market, and there have not been too many in recent years, actually even decades. That is a good sign of faith in domestic markets, both the consumer as well as investor, and not all MNCs for various reasons go down this twin route. And of course, it's an IPO from the East. Most listed subsidiaries of MNCs in India hail from Europe or North America. This one obviously comes from South Korea. What are the concerns? Well, large IPOs can suck out more liquidity than there is and kill appetite for some time. Also, large IPOs have often coincided with market peaks, even though they may not have been a direct correlation. On the other hand, of course, is the price, which is quite tightly valued, at least that's what analysts are saying, which means that there could be limited upside, at least for the short to medium term. Another concern is that the money being raised is going to the parent company and not into Hyundai Motor India for further investment. Let's come back to size. A report in the Economic Times says that of the 6 mega IPOs worth at least 10,000 crore rupees and more seen on Dalal Street so far, 5 of them gave negative returns on listing. Not just that, IPO investors who've held on to the stock in hopes of a turnaround are still sitting on losses, according to data from Prime Database. The Rogues Gallery includes companies like Paytm and New India Assurance, among others. The only IPO that did and has done well is Coal India. So the only message I could take away from that is there is a bigger fortune under the ground than over it. And not to mention that if it's government-owned, then that could be a bonus. But then Hyundai's vehicles ply above ground. On the flip side, the company's financials are strong with sales of close to 70,000 crore rupees last year and profits of a little over 6,000 crore rupees. This is full year. So this is no deep in losses tech company selling a future dream or even fantasy, rather a tested product company that's been selling cars in India for close to 3 decades and exporting them from world-class factories in Tamil Nadu. Hyundai's margins and price to earnings at this point are running close to Maruti, so you can see where and how this is being pitched. The Koreans versus the Japanese on Indian soil. Hyundai's margins are a little better because of its portfolio, which is the higher margin sports utility vehicles or SUVs. Abhishek Gaushinde, an analyst I spoke to from Sharekhan by BNP Paribas, says the Hyundai IPO is an opportunity to buy an MNC and a passenger vehicle stock, given that Maruti Suzuki is the only pure play car stock. Mahindra & Mahindra and Tata's financials also reflect their tractor and commercial vehicle businesses respectively. He also argues that Hyundai India does not need any money as such because it's generating healthy cash, so the funds going to the parent is not really an issue. So the arguments for and against seem evenly matched, though the ones for are based or seem to be based more on fundamentals, while those against more on sentiment. It'll be interesting to see what scores in the next few days. Maybe Hyundai will deliver another Santro, something people laugh at in the beginning, but then embrace over time. And that brings us to the top stories and themes for the day. The stock markets rise after a break and then stabilize. Retail inflation jumps to its highest level of about 5.49% for 2024. Wholesale price index also jumps. The rupee hits a lifetime low. Why is the Reserve Bank not defending it now? The Nobel Prize in Economics goes to academic work on inequality between nations. And what are mobile phone sales trends telling us about consumer behavior, particularly in the festive season?
This is the Core Report with Govindraj Ethiraj.
The markets stabilized at the start of the week. Well, it was a collective sigh of relief of sorts as markets gained on Monday, following, among other things, record highs on Wall Street over the weekend. Interestingly, financial stocks did well in India as they did on Wall Street's latest run over the weekend. The 30 stock Sensex rose about 591 points to close at 81,973, while the NSE Nifty 50 was higher by about 163 points to close at 25,127. So the big event for today, as we've discussed, is the Hyundai IPO. Reuters quoted LSEG data to say that some 260 companies have raised more than $9 billion so far in 2024 through IPOs, that is. And the year-to-date volume has already crossed the 7.4 billion total raised last year. Interestingly, Hyundai's IPO will also be the second largest IPO globally this year in terms of money raised, following a logistic company called Lineage's $5.1 billion US IPO in July. Hyundai is India's second largest automaker after Maruti, so let's see where that goes. The rupee hits a lifetime low. The Indian rupee has now dropped to an all-time low on Monday thanks to persistent dollar demand from foreign banks, according to Reuters. The rupee fell to a lifetime low of 84 rupees 7 paise to the US dollar, crossing the previous low of 84 rupees 7, but lower numbers on the decimals hit on Friday. The rupee had spent close to 8 months near the 84 mark, but not actually breached it, thanks to frequent interventions by the Reserve Bank of India. So the rupee has faced considerable pressure, thanks to foreign investors pulling out close to $8 billion over the last 10 sessions. On Monday, the weakness in Asian peers, thanks to disappointment over China's stimulus, also weighed on the rupee, according to traders who spoke to Reuters. And one of them said that the dollar-rupee pair is likely to hover now in the 83 to 84 range, or rather specifically the 83 rupees 95 paise to 84 rupees 20 paise range in the near term. So where could the rupee go now? I spoke with Amit Pabari, managing director at CR Forex, and I began by asking him what had changed.
So there are three reasons why rupee, was able to cross the 84 key mark. The first reason was FII have been able to sell in Indian equity and debt market close to 6.5 billion in the month of October. Second reason was oil prices, which were very stable in the month of September. In the month of October, the price went up by 10%, which was adding pressure on our current account deficit. Final point was, if you see the entire emerging market asset, currencies, you will see that dollar, which was very stable in the month of September, which came down at 100 kind of a level. Now from 100 level, it has moved to 103 kind of level, because of which all emerging market currencies have got weaker. I have to compare in terms of percentage. Dollar index got weaker by 2.5%. Other currencies have got weaker more than Indian rupee. So basically, we can say that other currencies have also got weaker, and we have outperformed them in terms of percentage.
Okay, so that's a fair point if you look at it in contrast to other Asian currencies, for example. But my question is still the Reserve Bank's own intervention, because the Reserve Bank's intervention so far has been to keep the rupee in that very tight range, and it was not allowing it to go beyond. So are we also therefore saying that the supply pressure was so high, or the selling pressure was so high, including by the portfolio investors, that the Reserve Bank could not do anything about it or could not be strong enough?
Rupee touched 83 on 17 October 2022. Basically, in the month of October 2022, it touched 83. I might not be as accurate with the dates, but in the month of October 2022, it broke 83 level. From 83 to 84, it took 2 years for rupee to touch that level. Now, that 1 rupee is an interesting point, but let me give you one more data point. If I have to book a forward, 1 year export forward or 1 year import forward, the premium percentage is close to 2%. So basically, 2 year premium would come around 3.5-4%, and rupee have got much. Rupee was so stable that forward premiums are much more than the rupee volatility. So basically, we can say that RBI was in full control in managing the volatility of the currency. Now, third point, when I say that why I think that RBI was able to manage it very well, because every time, whenever the inflow came, they used to buy reserves. Now, at $703 billion, once upon a time, we were fragile 5. Now, we are the country with the 4th largest reserve. So basically, RBI is in full control and doing a fantastic job as far as managing the currency is concerned.
So you're saying in some ways the market has got spoiled by the fact that the Reserve Bank was keeping it in that 83 to 84 band and now it's allowing it to go a little bit?
Too much of intervention on either side is bad. So, you allowing it gradually to move up or down, that is what any central bank will do. They will not try to protect a level. They will try to, maintain the volatility, which I think they have been able to do it fairly well.
Right. And Amit, as you look ahead next few months and all the factors that you talked about, including the volatility in oil and currency, of course, is still there or going to be there. So how is it looking?
If you an interesting observation, if we have to predict the view of dollar rupee pair, the first thing what we all see is where is dollar heading or how is US economy is going to do. If you see the dollar index, which is currently trading near 103 kind of a level, we think that dollar index is going to come down towards 100. And in the year of 2025, dollar index is going to break that key level of 100 and probably move towards 97 to 95 kind of level. Now, the reason why we say this, the dollar is going to get weaker, one of the most important problem what US economy is facing currently is its rising debt level. Now, whichever party is going to come, winning the election, both will be taking steps which is going to increase their fiscal deficit and which is going to increase their debt. And if the debt continues to increase at this level, then definitely dollar is going to get weaker. 25-30% of what US is earning, that is, they are spending on the interest expense. So these are the main problems. So if dollar gets weaker, then broadly all Asian currencies are going to get stronger. That is one objective. Second interesting data point is we have close to 85 billion trade deficit with China. Now, currently CNY INR is trading close to 11.90. If dollar gets weaker and this Chinese currency gets stronger and RBI allows rupee to move higher towards say 84.5, 85 kind of a level, it will have an adverse impact on our trade deficit with China. Because of this reason, we feel that 84.25 to 84.30 will be a strong resistance for the rupee, and rupee should ideally move back towards 83.80 and 83.5 kind of level in a couple of months' time.
That's very specific. Thank you so much, Amit, for your time.
Pleasure is mine.
Goldman lifts China's forecasts. China continues to gain in the eyes of investment banks. Goldman Sachs has upgraded forecasts for China's economic growth in 24 and 25 after Beijing unveiled a series of measures to shore up growth, including plans for greater public spending announced over the weekend, according to Bloomberg. Now, Goldman Sachs expects China's GDP to expand 4.9% this year, up from 4.7% previously. It also lifted its growth prediction for next year to 4.7% from 4.3%, according to that report, which was released on Sunday. The latest round of China's stimulus clearly indicates that policymakers have made a turn on cyclical policy management and increased their focus on the economy, according to Goldman economists who wrote that report. The Chinese finance minister said that close to $325 billion of local government special bond funds will be used in the fourth quarter, suggesting a more backloaded public spending schedule and a bigger growth rebound than what Goldman anticipated. Interestingly, it's in further action to allay concerns about the economy. Officials in China on Monday promised to ramp up pro-business policies, including unspecified measures to foster unicorn startups valued at over $1 billion. Interestingly, China's market regulator also vowed to crack down on officials collecting excessive fines to shore up falling income. Now, these steps appear intent to improve sentiment in the private sector, which accounts for more than 80% of urban jobs, but has seen its profits squeezed by the slowing economy and falling prices, said Goldman and reported by Bloomberg. However, Goldman did warn that China's structural challenges remain and maintains its forecast for 26 and beyond. Inflation hits a 2024 high. A sharp rise in food prices and an unfavorable base effect pushed up retail inflation to its highest level in 2024. That's for the month of September. Data released by the National Statistical Office or NSO on Monday showed that India's CPI or Consumer Price Index based headline retail inflation figure was up to 5.49% in September compared to 3.65% in August. Earlier in December 2023, retail inflation had stood at about 5.69%. So food inflation is clearly going out of control again, rising to 9.2% in September from just 5.6% in the previous month. All of this is thanks to a jump in the prices of fruits, about 7.6%, and vegetables close to 36%. Meanwhile, prices of cereals, eggs, meat and fish all slowed down. Earlier in the day, India's wholesale price index-based inflation rose to 1.84% in September on the back again of higher food prices. Now, this was lower than the 1.92% projected by economists in a Reuters poll, but was up from 1.31% in August. Mobile phone sales, what are they telling us? India economy watchers like me are also watching the present festival season closely to see and catch any early trends. Remember, heat waves followed by very heavy monsoon rains have seemingly disrupted many purchase patterns, for example, for cars. And then, because festive seasons have not coincided month on month, there could be some discrepancies and comparison, and more on that shortly. All of this could get sorted out by the end of the month. Meanwhile, what are smartphone sales numbers saying? Well, some 35 of some 157 million smartphones could get sold in the festive period. The first wave of the festive season sales, that's September 26th to October 7th, saw a fall of 3% in smartphone volumes at about 13 million units, but the value was higher and was up about 8% year on year, crossing about $3.2 billion. So in the first wave, online channels contributed to about 70% of total smartphone sales. That sounds very worrying, but do hold on and wait for the explanation that will follow in a moment. Entry-level smartphones face low demand, dragging down overall performance. All these numbers are from Counterpoint Research, who say that revenue grew driven by a 7% rise in premium handset sales price above 30,000 rupees. Now, all of this happened as consumer demand in the entry to mid-tier smartphone segment was weak and buyers held on to existing devices thanks to limited options under 10,000 rupees. Now, there are some interesting behavioral patterns within the festive season itself and the shifts between online and offline, and how and when consumers are buying or bought, at least so far this year. I spoke with Tarun Pathak, Director of Counterpoint Research, and I began by asking him to talk about the festival season and what the early data was telling us.
Very important point. Actually, if you look at right now, first of all, let us define how we are defining the festive season. So, Counterpoint defines it as a period of roughly 34-35 days, exactly from the day of when this online sale starts kicking off, like Big Billion Day, Amazon, Great India Festival, and the day of Diwali. So that's what we define festive season sales. So it's roughly like 5 weeks of festive season. Coming back to your question, so what we are looking at, there are certain categories of within consumer electronic that are growing fast. And when we say growing fast, those can be multiple attributes. So one, they can grow faster on the value terms, or they're growing on the volume terms. Here, if we look at from the smartphone perspective, of course, they have grown in terms of value year on year. But then there are certain other categories that were more or less muted. Like, for example, auto sales were a bit muted. Then we are seeing apparels are actually growing much faster than the smartphones that we have seen in the initial trends of the festive season. In fact, the wearables, the headphones, the smaller accessories items that are growing faster year on year. So the uptake rate has been quite strong, what we have observed. The larger categories, like, for example, what we have seen in terms of refrigerators, ACs, those were down a bit in the initial festive season sale, because largely, if you look at this time, the festive season starts right in middle of those Sharaat period, what we observe in northern India. And now I was talking to one of a retailer, and very interesting conversation that came out. And the retailer was saying that until last year, consumers were still holding on to the purchase of consumer electronics during Sharaat period. But this time, they are saying that this is something which is more of a necessity to them. And what they were holding back is something they are going to wear, or a larger item like, let's say, TV, fridge, or anything which is consumer appliance, big ticket item. So that's the narrative that is changing. In fact, I was just before coming onto the podcast, I was looking into the data. on the zonal level. And we thought like month on month, second half of August as compared to second half of September, North region might be declining. But it was exactly the opposite. North region was actually the month on month growth in terms of your smartphone. So that is a signal that consumers buying process is changing, thought process changing. And another item is, if you look at what was a big change from the last year, was how these devices are being purchased. Like EMI has played a big role this time, and that is why we can discuss this later. But that is why the premium market has grown 7% year on year in our survey as compared to the last year. That is what we have observed.
Right. So, if you were to sum up that part, you're saying that consumer behavior is changing. They're not as, let's say, bound to periods like Shraddh when people usually don't make purchases in India. And therefore, I'm guessing they're going by the deals that they have on offer. And the second, of course, that we've talked about earlier as well is the fact that EMIs are driving more premium phone sales. Is that something that you still see happening at the same level?
Yes, we are still seeing almost like 55-56% of the premium smartphone sales are still happening on EMIs. So that's a big, if we compare it with like countries like US or even China. US is different because obviously you have operator market very strong. But if we talk about open markets, this number might be lesser than even 20-25% as compared to India. So India stands anomaly. Like we have online sales. If I look at on an annual basis, somewhere closer to like 48%. The next closest market could be somewhere in Europe, which is closer to like 33-34% online. So these two things are happening in a big way in India. And we believe the biggest driver is the youth, because youth need something which is the latest and the greatest. But at the same time, they also want to bridge this affordability factor, which they can do with the help of these EMIs or the financing in one way or another.
And you're saying that the jump in online is sharper compared to previous, let's say, festivals or full year or half year.
Yeah, it was like first wave, everyone anticipated like it's going to be all online, because the kind of offers, deals they were giving, that was like 40-50% cheaper as compared to the non-offer period. So that was understood. The only thing is the first festive wave. So because even this, the entire festive season that I told you, 35 days, we divide it into three phases. First phase is the first wave that we have just seen, 26th September till 7th of October. The second wave has just started. We are in middle of it. That will go until like 17th or 18th of October. And then the third is until Diwali, which is more offline. So first is very heavily online dominated. 70% of the sales are online. And then somewhere in the middle, the focus starts shifting more towards offline, because as we reach closer to Diwali, there are a lot of impulse purchases that are happening in the offline. So as we move closer to the Diwali period, it will start shifting towards offline. But the first sale was 70% online as compared to 74% last year it was. So there was a dip because this time some of the offline players have started matching the offers in online. We have seen a lot of these offline players, they are saying, okay, we are going to match the price that is there on the online. But then convenience and everything that takes over, and a lot of these users went in favor.
And it averages out to about 50-55% online versus, so it's almost half now.
Yeah, last year it was like closer to like 62-63% during this festive season online.
No, what I'm saying is now the overall, the annual averaging out.
Annual averaging out is 48% online, but this year we are expecting 45% online. Offline will grow, a bit.
Okay, that's interesting. Last question, Tarun. So, how are you looking at your overall projections for the whole year or the rest of the calendar and particularly the last quarter?
We are still estimating 3% year on year growth in terms of volume. We still think the Indian smartphone market will reach closer to like 156, 157 million out for the entire year. So that's mostly on the volume. And this is something what Counterpoint has predicted. So we are very similar with our prediction as of now, because nothing has changed in a big way, unless until some brands will sit on inventory after this festive season and the selling declines significantly in November. Then we might tweak a bit by 1 or 2 million, but and in worst case it will be flattish.
So, 137 to 140 million,
157 million is what we are estimating.
sorry, 157 million smartphones and feature phones.
Feature funds closer to 60 million. That will be down from it will be closer to 55, 56 million. That will be down from 60 million last year.
Right. Tarun, thank you so much for joining me.
Yep. Thanks a lot.
And the Nobel Prize of Economics goes to US-based economists Darren Acemoglu, Simon Johnson, and James Robinson were awarded the Nobel Prize in Economic Sciences on Monday for their work on wealth inequality between nations. The Nobel Committee said that their work has helped show why societies with poor rule of law and institutions that exploit the population do not generate growth or change for the better. And this, the committee said, demonstrated the importance of societal institutions for a country's property. Acemoglu and Johnson are professors at the Massachusetts Institute of Technology, while Robinson is director of the University of Chicago's Pearson Institute for the Study and Resolution of Global Conflicts, with a specialization in the economies of sub-Saharan Africa and Latin America. Acemoglu and Robinson wrote the popular 2012 book, Why Nations Fail: The Origins of Power, Prosperity, and Poverty, which explores the root of inequality and why some countries successfully gain wealth and influence, according to CNBC's report. The Nobel laureates have pioneered new approaches, both empirical and theoretical, that have significantly enhanced our understanding of global inequality. The director and professor of economics at Stockholm's University Institute for International Economic Studies said during a press conference. The question of why the gaps between poor and rich nations are so persistent is not new, but remains amongst the most urgent in social sciences, he added. That was the Core Report with me, Govindraj Ethiraj. Do stay connected with more of our coverage at the Core. You can check out our website or sign up to our newsletter for our exclusive stories, one in-depth feature a day on www.thecore.in. Do also track us on LinkedIn, where we usually post synopses or extracts of our top stories and interviews. We would love your feedback on how we can make business more interesting and relevant, including, of course, India's vibrant manufacturing sector. So write to us at feedback@thecore.in. And thank you once again for listening.